Hey guys, Humphrey here. So my dividend portfolio currently pays me around $100 a month in passive income, and I know that many people are looking for this, and I think dividends are a really great way to tap into that. They're naturally pretty passive because a dividend is basically a percentage of profit that a company will pass back to their shareholders just for owning that stock. So basically, if you have a large portfolio of many different dividend stocks, you're just getting these dividend payouts regularly over time, and when you compound these dividends, the effects can actually be really quite amazing. In today's video, I'll be revealing my exact dividend portfolio that does pay me over $100 a month. We'll talk about how to choose dividend paying stocks, my favorite picks in my dividend portfolio, the pros and cons of dividends, and much, much more. Also, a large percentage of my viewers are not subscribed, so consider subscribing if you really like this video. It's free and you can always change your mind later. So whenever you're thinking about how to choose stocks for your dividend portfolio, you should be doing some due diligence on that company. Now, there are many different ways to do due diligence, but they can be boiled down to basically 3 steps. Number 1, I would definitely go ahead and read their business overview in the 10K annual filing. Now you can find this filing by going to sec.gov, going to company filings, and then typing in that company. Once you find their 10K, read the business overview and try to get a sense for how this company makes money and how it's either going to stay stable or grow. Now, after you figure out what the company is about, number 2, you can start to look at the different company specific metrics like PE ratio, enterprise value over EBITDA, the dividend payout ratio, and also their dividend yield. When you look at metrics like these, the indicators aren't that helpful unless you actually compare it to something else, so unless you have some context. So a common comparison that you can actually make is to look at the stock's industry group, a benchmark index like the S&P 500, or just compare it to the historicals of that particular stock. To do that, you can use a stock screener website like finviz.com. Now, in the beginning, you might be a little bit lost, but as you gain familiarity with the different stocks and their metrics, you'll start to gain context on these indicators and be able to identify certain opportunities. An important metric that I'd actually like to talk about is the dividend payout ratio, since we're talking about dividend stocks. And that's represented as total dividends paid divided by the company's net income. So for example, if a company gets $10 million a year in profit and it pays out $5 million a year in dividends, that means they're paying out about 50%. So a 50% dividend payout ratio means that the company is paying out half of their profits in dividends every single year. The more a company pays to its shareholders, the less they're actually reinvesting into their own business. So that's actually a pro and a con of a dividend paying stock, but ideally you want a business that's able to continually to pay out dividends and not hamper their growth while doing so. The ideal dividend payout ratio is somewhere between 35 to 55%. That's considered healthy. Now, high is somewhere between 55 and 75%, and very high is 75 to 95%. So besides looking at those metrics, number 3, you can also look at the track record for paying dividends. So if we pull up dividend.com and search for a ticker, say 3M, which is ticker symbol MMM, you can see a lot of data about 3M's dividend growth and history. They've been paying dividends consecutively for over 59 years, so you know that they're most likely going to continue to do so since it's basically built into their business model. There are plenty of other stocks that do this as well, and some that come to mind are Coca-Cola, which also has 59 consecutive years of dividends, and Home Depot, which has over 26 consecutive years. So now I want to show you guys my dividend portfolio, so I'm going to head over to my desk over there and share my screen. All right, guys, so here's my dividend portfolio in spreadsheet format. As you can see here, it is quite a lot of extensive information, but I felt like spreadsheet was a lot easier to read than Fidelity. Now, I will show you quickly that this spreadsheet basically reflects my Fidelity account right here. But we're going to be operating mostly with the spreadsheet today because my Fidelity account has index funds holdings, which aren't really that relevant. And I feel like the Fidelity interface is just a little bit more confusing. Now, by the way, if you do want to see everything I invest in, that is available in my Patreon, which will be linked below. But for today's video, I'll only be showing you the dividend portfolio side of things. Okay, so there is a lot going on, so feel free to pause the screen at any point if you want to study all the holdings. But let's talk about some of the notable holdings of this dividend portfolio. My biggest source of dividends is actually coming from AT&T, which is ticker symbol T, which currently pays over a 7% dividend yield. Admittedly, I purchased this at $28.79 per share. And clearly, even though it pays around $400 of dividends every single year, I'm actually down around, let me see here, $300 on this stock, I believe. Yeah, I'm down $297 on the stock itself at the time of this recording. Now, for dividend investing to be really magical, we really are looking for companies that pay dividends while either remaining flat or even appreciating in value. Now, you'll see one of my best winners here is actually American Express. I'm up $741 or 74% on it. It also pays, I think, a 1% dividend, 0.99% dividend yield. on this stock. Now, 1% isn't a lot, and that's because its payout ratio is around 20% if we look on Yahoo Finance. Now, American Express's main purpose of this portfolio is that it just helps diversify the portfolio a little bit with a balance of growth along with dividends. Now, a more true dividend stock here is something like Kraft Heinz Co., which actually has a yield of 4.37%. Not only am I up, I believe, $245 on this initial investment of $3,400, but I can also expect around $160 in dividends for Kraft Heinz Co. per year. Now, another source of dividends and growth is Apple, and admittedly, I've been a pretty big bull on Apple for quite a while now. As you can see, my cost per share of Apple was $64 a share. So I acknowledge that this isn't the best reflection of a full dividend portfolio since Apple is more of a stable growth stock, but it still pays a dividend, and that's why I'm keeping it in here. It's because of Apple that the profit and loss of this dividend portfolio is quite high. As you can see, it accounts for $22,000 of my $25,913 profit. Now, if we were to remove Apple, we would actually get a more realistic view of what my dividend portfolio looks like. So let's actually go do that right now. Let's actually delete Apple from the portfolio itself and just see how the portfolio changes a little bit here. By removing Apple, the total cost basis of this portfolio is now $24,000 and the total current value is around $28K. And you can see that this portfolio is up around $3,500 this year, or $3,591, which is around 12%. Now, I bought these stocks back in January with the exception of Kraft Heinz Co., which I've been averaging into over time. Now, with this portfolio, removing Apple, I'm actually still receiving around $1,000 a year in dividends from this portfolio, and this portfolio has been steady and consistent. If I were to add my Apple position back in, my total dividends per year is actually $1,259, or right around $104 per month, which is pretty cool. So even if all the stocks were completely flat for the entire year, I would still make around $104 per month, and I didn't have to do anything about it. One thing I wanted to show you guys was actually this manage dividends button in the Fidelity account. If you click on this, you'll actually see that for all of my dividend portfolio, or all my dividend stocks, on the left it says for dividends, reinvest in security. So what does that actually mean? We're gonna go through what reinvest in security means at my other desk. So let's go right back there and let's get right into it. When you get paid a dividend, you can either have it be reinvested in the security automatically, which means you're buying more shares of that stock with your anticipated dividend payments, or you can just have it pay out in cash to your account. Ideally, you're choosing reinvest in security. That means the next time you actually get a dividend payout, it's actually going to go towards buying more shares, so that when you have more shares, your next dividend will be higher, and then your next payout will be higher, and the cycle basically continues, so on and so on and so on. This is commonly referred to as an automated reinvestment plan, and this becomes super powerful the more time that you actually give it. Another name for this automated reinvestment plan is called DRIP, and that actually stands for Dividend Reinvestment Plan. But the term DRIP is usually referring to a formal program offered by a publicly traded company. If you have a brokerage account such as one with Fidelity and you choose reinvest in that security, you should automatically get access to any DRIPs by public companies. Now, the advantage here is that you may even receive new shares at a slight discount to its current market price. To illustrate the power of dividend reinvestment, I have these graphs right here, and this is pretty crazy, guys. The reason why you would want a dividend portfolio, let's say you put $10,000 into Home Depot stock on January 1st, 2000, and you held it for 20 years. With dividends reinvested, your total at the end of 20 years would be $88,284. Now, without dividends reinvested, you would have a total of $66,113. This difference is $22,171 over the course of 20 years, which is pretty significant. Of course, if you didn't reinvest the dividends, you would have received the dividends as cash, which means that that would have amounted to another 11.8K. So if you add that to the total value without reinvesting dividends, the total of that is going to be $77,935. That's still a total difference of over $10,000, so it's always important to be reinvesting dividends, in my opinion. Now, you can either do this in a taxable account like the one that I have, or a tax-advantaged account like the Roth IRA. It is important to note that with reinvested dividends, you're still paying taxes on those dividends because the IRS still treats reinvested shares as cash. So if you are starting a dividend portfolio, consider doing it in a Roth IRA because this means you won't pay taxes on your gains or your reinvested dividends. If you aren't sure of what a Roth IRA is or how to start one, make sure to check out my videos on that. I'll link them here and below in the description. A Roth IRA is basically an individual retirement account that helps you shelter your gains against taxes. All right, so who are dividends actually good for? There are some pros and cons to dividends. Now, in terms of pros, there are three that come to mind. Number one, passive income and peace of mind. I guess this is a two-parter, but it's a true form of getting money into your pocket passively. Now, if you do want to live off of dividends, you'll need to have a really sizable portfolio. As an example, if you wanted to live off of $50,000 a year, for example, your total portfolio value would need to be around $1 to $1.5 million at an overall yield of 3 to 5% per year. My portfolio, if you can see right here, sits at right around 1.8% dividend yield per year. And the way that I figured that out was I just basically divided my total dividends per year of 1,259 by the total value of my stocks. If I wanted to focus more on dividends, I might be able to get between a 3 to 5% yield on my total current value. And the way that I would do that is I would just redistribute the profits of Apple into some higher dividend paying stocks. But for now, I'd rather just keep Apple the way it is. The second pros of dividend paying companies is compounded returns, which I think we've already covered a lot with DRIP. And number 3, dividends are a good hedge against inflation, which we've already been experiencing a lot this year. According to this article on NASDAQ, high dividend yielding stocks outpace inflation over the long term. Even in cases where inflation might seem to bury them for a few months or even years, the high yield stock will often win out in the long run. So that's pretty cool. If you own some dividend paying stocks, you also get some protection against inflation, which is pretty cool. Now, there are some cons when it comes to investing in dividends. Number 1, you're mostly investing in large, stable companies, which can be good for some people. But if you're seeking more growth and want higher returns for taking on higher risk, dividend stocks are probably not what you're looking for. I mean, just look at this stock chart for Home Depot for the past 5 years. It's pretty stable and has almost tripled in that time. But if you compared that to a bigger growth stock like, let's say, Netflix, or a crazy growth stock like Tesla in the past 5 years, you would have had a much higher substantial return. Also, if you are investing in only large, stable companies, you're not really as diversified as you could be with a balance of other types of stocks like foreign stocks, small cap stocks, mid cap stocks, etc. The second con is that the returns can actually be quite limited. Since a company is continually shelling out cash, the underlying stock will have a natural type of friction when it comes to increasing their share price because it's not reinvesting in itself. Future dividend streams are taken into account when the market is pricing a stock, so just keep this in mind. The third con is that dividends aren't guaranteed. Companies can cut their dividend at any time, so you do have to somewhat pay attention to the market and basically figure out what it's doing on a monthly or quarterly basis. And dividend stocks aren't as passive as, say, index fund investing. I will say, though, one of the nicest things about my portfolio is that I know I'm getting a consistent $100 per month, and that's even at a low yield percentage overall. Now, as always, make sure to do your own research when it comes to dividend stocks. Don't just blindly go and copy my portfolio. I'll link some great resources below so that you can figure out what types of stocks you may want to include in your own portfolio. And also make sure to check out my Patreon in case you are interested in seeing everything else I invest in. Thanks for being here. Make sure to press the like button and subscribe to my channel, and I hope to see you guys in the next video. All right, peace.